I'm here with CEO Kasper Gisted from GreenMobility to look at their third guidance upgrade this morning. They are now expecting 15 to 17% revenue growth and 42 to 47% EBITDA growth. And actually from the start of the year, almost a doubling of the guidance range in the bottom range of this. But Kasper, what is it that has gone better this year? What is it that is driving this momentum that you didn't expect from the start of the year?
So I think it's a lot of factors. It's basically across the board of all of the activities that we have inaugurated in line with the big turnaround that we started back in 23-24 when I started. And I think that we are sort of reaping the benefits of that, or reaping the fruits from all of those activities that we've started there. So, I mean, if you take it from the marketing perspective, we have become much more efficient now. It's much more data-driven now. If you look at the top line, much more data-driven marketing than we have ever been. We have a full control of our cost of acquisition of the customers. I think it also helps us from a branding perspective that we now have so many vehicles driving around here, because every vehicle is a branding.
Yeah.
I think from an operational point of view, we are also performing better than ever. We have also, made a lot of activities on the whole operational part of the business. We have digitalized our vehicles so that we now have, cameras in a lot of them. We have damage detection sensors in them. We have a better standards of cleaning. So across the board, I think we have done a lot of activities, and I think that's what we can see the results of now.
Yeah, you also at the start of the year, you started to talk about this when A to B in the inner city transport the demand is low. You will try and push customers to do longer trips and rent the car longer. Has that also been a part of what has succeeded this year?
Yeah, so what we can see is, so traditionally in this company, we saw that it was a little bit difficult for the company to get, the regular customers, the commuter customers, when they're leaving the city in the summertime. It was difficult to get them, other customers to go in their place. And I think we have succeeded very much so this summer on getting people to drive longer trips, instead of being I usually say, I think we transformed the company from being a car sharing company with short trips, 35, 40 minutes trips, to becoming a car rental company. We have a very, very good business proposition for the customers. Instead of, you have to go into a rental car company office and rent your car there. You can just take it from the street and rent it for a day or 7 days or 3 weeks. And that's what we can see in the summer that a lot of more people have done.
You mentioned this. You have much more cars, meaning much more billboards. And of course, it's an advertising, but I guess accessibility also keep pushing customers actually to use it. If I much easier can get a car and much easier park it, it's much near me. I guess, doubling the cars might not only be cannibalizing, your current business, but also actually attracting new customers. Have you seen anything of that?
I think there are two aspects of that. So one aspect is, as you mentioned, is the top of mind positioning of our brand. I think we have become a very, very strong brand now, and we can see that actually on the data that we have, because we're measuring the brand awareness, and that has gone up tremendously. And due to the fact that we have more cars, but also due to the many marketing activities we have. And the other factor is that, yes, if you have more cars, you have availability for more customers. Obviously, you cannot just put in cars on the street and then the customers will come. So there's a fine balance between putting more cars on, but also being able to fill them up. And we have been able to fill them up this year, and we've done it to a bigger extent than anticipated, and that's one of the reasons why we have come up with this adjustment of the guidance.
And of course, a very strong 25. As an investor, we start looking into 26. Do we have enough levers to keep pushing? Do we have new levers? Do you still expect to get something from the levers you have put in this year to still drive growth? And I'm not asking you to guide, but give a feel of whether you feel the levers actually also give you continued momentum into next year.
Yeah, so I think I said it before. We're just getting started in this company. There's a tremendous amount of growth pockets laying around, ready to be picked up. We come from a situation where this company, before I came in, was heavily loss making, and we have turned it around now. It's a financially strong company. We don't have any debt, operational debt, and we have some good growth rates, as you can see. So now we can build muscles, and what we're using the muscles to is actually to go and get all of those various pockets of growth that we have identified. So yes, there is a lot still to become, and as I said, we're just getting started here.
And then let's look at one of the characteristics that you are actually almost 3 times growing earnings to revenue, meaning this operational gearing. What is it that is driving that more gets down to the bottom line of when a revenue when one krona in revenue gets in?
So this kind of company is like a high volume, low margin business, and there's a special recipe for that. So you have to be extremely sensitive about the cost base that you have. So and I've been in the car rental industry, and I've also been successful in those companies as well. And it's basically the same. You have in the airline industry, if you can run a good cost efficient airline like Ryanair or EasyJet, then there's a lot of money to be made. And that's basically the same that we see in this kind of business. You have to run a very, very extremely tight organization. If you look at our half-year result, I believe it was, where we had a 29% increase of the revenue, but without adding any more staff costs, for example. So it's a good example of how we really, really want to run this, because profitability is everything. Healthy growth, as I think I've coined it, it's our sustainable growth. That's really what we're aiming for, and it is, again, it's high volume, low margin business. It's a special recipe, and we follow that really diligently.
And does technology help you in this one?
Yeah, I think we are blessed with the technology development that we've seen. I mean, we have already introduced damage detection software in the cars. We have introduced cameras, forward, rearward looking cameras in the car, dash cams. Everything that helps us. Smoke detectors is another thing. It gives us, we're not doing it to get extra revenue, but we're actually doing it to get a better customer experience. With damage detection, you can be absolutely sure that we're not blaming you for damage that you didn't commit or didn't do. With smoke detectors, we are trying to prevent people from smoking, and now we can actually, give them a financial warning. If they smoke a vape in our cars, that gives us some revenue. Obviously, it's not revenue that we want. I call it toxic revenue. But it all helps to get a better customer experience, and at the end of the day, that's a better business for us with a better customer experience. And
I do understand that people look at you as someone running cars, but you are a platform company. It's very, very important that you can get customers into your business at the lowest cost, so what we call customer acquisition cost. Is technology also helping you there? Are you seeing a good development on that? Because I think in the end that is one of the most important parameters for you running your company.
Yeah, I think what we can see over the 3 years I've been here, almost 3 years to March, is that we have become much better in utilizing the data that we have. Technology is more or less the same on that. I know there's certain differences with AI and so on coming up, but from a data point of view, we have become much stronger. We're in full control of our cost of acquisitions and the lifetime value of the customers, so we know exactly when to invest, how much to invest in order to get a good return whenever we take in a new customer. So I think we have a very strong model on the marketing side, on the demand side. And
you're seeing customer acquisition costs coming down?
Yes, we're seeing customer acquisition costs coming down. We're also seeing now that we are, as I mentioned before, building muscles. We can actually utilize this momentum with the financial muscles that we have now to get even more customers in.
Perfect. And I did a small calculation on the rest of the year according to your new guidance, and a growth, but a little bit slower growth than what we have seen actually in the first 9 months. Are there some uncertainties you are seeing that we are not seeing from the outside in the market, or any reason for still having a guidance even if it's impressive?
Well, I think there are various factors here. So this company has been over-promising and under-delivering before my time. And when I came in, it was very important for me that we reestablished the trust of the investors, the investor environment. I think we have done that. You can have a look at our share price development, but it took some time. So that's one of the reasons why I say conservative is not the right word, but I want to be sure of the data that we are using before we're doing anything. And I've said that on numerous occasions. I will continue to say that we are data-driven. We are not a hope-driven business. So I think the history has a certain impact on that, but it's not until we get the right data that we are doing anything with our guidance at all.
Thank you, Kasper.